Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Daryl Thomas, and today we have the pleasure of interviewing Adam Taggart, the CEO and founder of Thoughtful Money. How you doing today?
I'm doing great, Daryl. Thanks so much for having me on. It's a pleasure to be one of your first interviews here on the VRIC Media channel.
Yes. Some may call me a newbie, or a noob, but I am pretty experienced in this, and so I'm happy to be here with VRIC and happy to be here with you today. So I've been, reading a lot of your posts on X and everything, and one thing that I've noticed is that you have a real desire for people to succeed, especially the average American. Mm-hmm. And I noticed a lot of your posts are related to that. And so I was doing some snooping around on your LinkedIn and saw you've been in the industry for about over 30 years and on Wall Street and Silicon Valley and such. And then, you got your start in the mid 90s with Merrill Lynch. And so I'm curious and just like from your perspective, what has changed since you started in the markets, economy? What are you optimistic about in today's markets, and what are you concerned about?
Okay. Well, definitely one of the things that's changed has been the white on my face here in that career. So thanks for telling everybody. I've been in this industry long enough to be pretty old. So let's see, where to start. What's changed in the markets? So I started my career on Wall Street in '94, and I came to this sector accidentally. I'm not one of those people who, aspired to be a finance guy. I was about to apply to medical school, and for a whole bunch of reasons decided not to at the last minute, and ended up on Wall Street, really kind of a fish out of water. And honestly, was not a good fit at all for the culture there, and kind of got a very early front seat view to the fact that Wall Street, its primary priority is to itself. It's not to its clients or humanity at large. It's really just to make as obscene as amount of profits as it can for itself in all situations. And look, our capital markets play a necessary function. I'm actually a huge capitalist, so I'm very pro-capitalism. But Wall Street does not exist to help the little guy, and that's a big reason why I went on and had the career I had, and now eventually, founded Thoughtful Money. But in terms of what's changed in the markets has really been the shift from a respect for natural market forces and natural market cycles and natural business cycles to this ever increasing perpetual intervention to try to support asset prices, to what I like to say is try to prevent winter from ever arriving, to try to have it be perpetual summer all the time in markets. And the longer that you intervene and distort natural market forces, the more you deform the system, the more you push it away from true price discovery, the more you eventually create asset price bubbles. And we've done that at hyperscale in the markets and in the economy over the past couple of decades now, I think with an ever increasing basis. Folks obviously saw that in the run up to the dot-com bubble, but then they saw it in our housing stock with the housing bubble. And now we're sort of in this everything bubble market that had that moniker, Daryl, before COVID hit. And then when we saw the, just mind-bogglingly unprecedented amount of stimulation that was pumped into the system in response to COVID, those deformations just went into hyperdrive. And to be honest, we're still very largely dealing with the fallout effect of that. We've seen huge acceleration in wealth inequality. Obviously, with COVID, we saw a huge increase in the price of living, which has contributed to that wealth inequality. But here we are. We're back at record all-time highs in just about every asset class at this point in time. And when you look at relative valuation metrics, they're amongst the highest they've ever been. So it's not, these all-time record high prices aren't supported by the fundamental underlying data of just earnings. Multiples have gotten stretched to, again, like I said, near, or in a number of cases, at all-time highs, right? So the system has become, I would say, a lot more deformed from when I started my career, and the increasingly the mandate of central planners is just to try to keep everything going the way that it is, because the more deformed the system gets, it loses its shades of gray. It really only kind of has two states: either everything's amazing, and we're back to that now, or everything is collapsing, right? And we started to see a bit of that in April, and that was very quickly reversed. But certainly, I don't need to tell most people watching this video, they've got their own memories, over recent years, decade plus. The markets are generally either in an everything is awesome mode, or things are falling apart faster than we can imagine. And of course, that then leads to the next intervention. Now, we can, make arguments for maybe we should just let natural market forces have their way, let all the malinvestment and distortion clear the system, and get back to a much more sustainable baseline where we can invest much more confidently as investors. To be honest, I love that logic, and a big part of me would love to see it happen. I don't necessarily think it's going to happen, though, because, or at least not willingly, because I just don't think there's any sitting politician that would want their name associated with the immense amount of pain that society would take if that were to really happen. So I don't think it's going to happen, like I said, willingly. It might happen at some point unwillingly if the system really gets away from those who are trying to control it. I don't think we're in any imminent danger of that, but is that something that could happen at some point over the next 10 years? Yeah, absolutely. And we're certainly going to have more cracks along the way. So to wrap it up here, I think the thing that's changed the most has been this departure from natural market forces to a much more centrally managed economy and financial market system in the developed world.
Yeah. You said a lot there, a lot of threads to pull on there. One thing that really that I want to dive in a little bit deeper is we're in an everything bubble. You mentioned wealth inequality, which is a huge problem. I was reading a post earlier about the millennials and Gen Z being very critical of the baby boomer generation for a lot of the policies and benefits they voted in and such. And so I had to actually go back and do some research. Well, I use ChatGPT, no shame there. Like what policies and benefits did the baby boomer generation vote in? And a lot of the deregulation of housing that led to like the housing bubble and the tax cuts under Reagan and all type of things that led to many of the issues that we see today, and that the younger generations are having to navigate. And with that, you mentioned being a capitalist. I'm a capitalist too, and I've seen folks. Sometimes I go to the comment section of some videos, like even if I look at, Ray Dalio explaining where we're at in this debt cycle and what problems are ahead, and I see a lot of comments criticizing the billionaires, saying like, oh, we got a billionaire teaching us how, what's going to happen and the dangers and a lot of blame there. Yeah. And I don't necessarily think that that's the solution. Just from that, like holding that in the focus, what are your thoughts on this whole thing of wealth inequality, but then also the blame is being, people are trying to figure out who to blame, Sure. And you mentioned like no sitting politician is willing to go through some form of pain, but you got generations blaming other generations. You got people that don't have as much wealth blaming the wealthy and such. And this is a dynamic that is very problematic. And I don't think it really has, I don't think it really leads to any solutions. And so just want to get your perspective on that.
Sure. And I've got a lot of thoughts. I'll try to keep them as concise as I can. So, history, runs in cycles, and there have been times where, you've heard the whole, like, good men create, hard men create good times create soft men create hard
Bad
times.
Hard times. Yeah, I got
you.
So,
there's that goes on. So wherever you parachute in history, there are going to be moments where, generations are at odds with each other because they think each other had it easier, right? Or one of them had it easier. But what has, and look, I'm just to be really clear, I am a capitalist, and I'm not a socialist or a communist, and I don't believe everybody should in an economy or society where everybody is absolutely equal economically, it's just not realistic, right? We should be equal in terms of the fairness of the laws that apply to us, but in terms of our own individual states, a huge reflection of that is going to be based upon our ability to work hard and our own individual talents and stuff like that, right? Our own pursuit of our own happiness. People are going to pursue different forms of happiness, and they're going to pursue them with different intensities. So you're always going to have some differentiation there. I also am just a believer in the Pareto principle, right? Which is, the 80-20 distribution, right? And over time, wealth will probably concentrate more or less along a Pareto distribution, where you'll have 20% that have a lot more wealth than everybody below, but that's because in general they work harder and have had more good fortune and all that type of stuff. What you want to create is an environment where everybody basically has the same odds of making it into that top 20%. Right, that you're starting from a place of fairness, that the rules are fairly applied to you, that if you want to work hard and be innovative and whatnot, that you've got an equal shot of being one of those in the top 20%. So again, I'm not trying to say we should strive to the super flat society economically, just because I don't think it's realistic. Now, that being said, over the past several decades, first off, the boomers will probably be angry at me for bringing this up, but the boomers were the me generation, right? They adopted a much more sort of self-centered, one might say narcissistic view than their predecessors, right? The greatest generation was all about, fighting the wars and what we can do for society. The boomers were much more, well, okay, but what's in it for me, right? So you have some of that starting off in this group, right?
It's like, mom and dad, why?
Yeah, exactly. They also were very fortunate, and I don't blame them for this, but the boomers probably lived at the greatest acceleration of individual prosperity in human history, right? Especially if you lived in America, right? Where we were the only man standing after World War II. We basically helped the rest of the world we built. We were the world's manufacturer. You could have the middle class exploded because there was so much opportunity to get a good job here and raise a family, without having to work, 100+ hour weeks in sweatshops and stuff like that. So they had a really good tailwind behind them. But as they amassed wealth and then voting power, right, as they formed capital and then became the dominant cohort voting-wise, not sort of unsurprisingly, politicians catered more to them. As politicians became boomers, they started writing much more boomer-friendly laws and regulation. If you look at the tax code, it's a ridiculously thick document, right? And the first page says, okay, this is what you have to pay in taxes, unless, and then that's the rest of the document, unless you invest in these type of properties, unless you do this different sort of thing, right? And so the rules and regulations increasingly got favored to those who owned assets. And as the boomers, became the largest and wealthiest cohort, every time something was done or engineered to support asset prices, like bail out the housing market, right? The Fed stepping in, buying mortgage-backed securities, like the Fed running QE for QE 1, 2, 3, 4, in the decade after the global financial crisis, where we weren't in any kind of crisis anymore. All that stuff was to goose asset prices. Well, who owns asset prices? One, the boomers, the older generations, because wealth has a strong correlation with age. And then, the wealthy, right? I think it's something like 93% of all financial assets are owned by the top 10% of households, right? So, you've just had this accretion of advantages that have been benefiting this class, and that, just like the magic of compounding, that compounds over time, and they leave people further and further behind. The other thing, kind of the double-edged sword of a lot of these policies that were pushed out there, QE, both monetary and fiscal, great examples of this, is they goose asset prices. But what else do they do? Well, they just increase the prices of everything, right? So if you are not one of the wealth holders, you don't get the boost in asset prices, so you don't get that benefit, but you do get the pain of an increase in your cost of living, right? So that means you're getting left further behind at a faster pace than those who have assets, right? So it's just kind of been this natural progression of people who had advantage reinvesting that advantage to continue to further their own advantage over everybody else. And it's not just, in the citizenry. We've definitely seen the same thing in corporations, where you're pretty hard pressed these days, Daryl, to find an industry that has not become a corporate cartel, that is run by a small number of very big companies who have worked with DC to influence regulations such that it is kind of prohibitively challenging for a new competitor to break in and really threaten them. And so, okay, so who benefits from that? Well, the people that run and own those companies. Well, those tend to be the older boomer generation. So there's been this confluence of factors that have contributed over the past several decades to end up where we are. Now, of course, the really toxic side of that is you start to then, your younger generations, when they start to realize, hey, look, that brass ring that I've been sold on, hey, if I just work hard and do everything I'm supposed to do, I'm going to be able to achieve that lifestyle. They start to doubt that they have good odds of getting into that top 20%, like I mentioned earlier. And when that happens, when they lose faith in that social contract, that's when really bad things start to happen, right? That's when they either start checking out. So we have literally millions and millions of able-bodied Americans, working age, who have just given up, who are literally living in their parents' basements, just saying, look, why bother, right? I mean, if I work, I don't really get much for it, so I may as well just kind of, try to claim disability and sit here and play video games and smoke weed or whatever, right? And I'm not trying to denigrate those people, but I'm just saying that's what happens when you give up, when you lose hope, right? It breaks your morale. And then similarly too, you get people that say, well, look, this system's just not working for me, right? So there's sort of the class war and demographic war antagonism that you were referencing earlier, where like, hey, it's all those damn boomers' faults. Let's go get the boomers, right? Or the eat the rich, chant that you're hearing a lot now. But also just like, hey, look, I don't think capitalism works anymore, because you say we're a capitalist society, but I don't see myself ever being able to afford to buy a home, right? Or to afford to start a family, right? So what's really dangerous when people get to that stage is they start looking around at alternatives. And there are people who will try to sell them an alternative, like, the socialist agenda. And look, I'm very apolitical and I'm very independent by nature. At Alpha Money, I'm extremely apolitical. But I think history economically is very clear that socialism does not end well. But if you're a younger person who is really demoralized and you've got a choice at the voting booth, and you kind of feel like I'm getting screwed by the current system, you're like, okay, you're telling me that socialism doesn't work anyway. It doesn't work either. But at least that guy's going to give me some free stuff along the way. So, do I go with the guy who's going to screw me and I'm not getting anything for free, or do I go with the guy who might screw me, but I'm going to get free stuff? I think I'm going to go with that guy, right? And I think that's a very dangerous Pandora's box to unlock. And I think, sadly, we are pushing a lot of the younger generation towards opening that box.
Yeah. It seems like from what you've explained, folks that are in power are picking and choosing losers. Whether they want,
the more you centrally plan, that's what you do. Yep,
exactly. And with that, we have this dynamic of baby boomers living longer. People are living longer. I mean, health advances have health science has advanced, and then we have birth rates dropping. People are like, why would I even want to have a kid, in this economy, and such. And so that seems like the compound on the problem as well.
Yeah, no, in some ways that's sort of societal suicide, right? I mean, if you demoralize your fertile generations to the point where they go on strike and they no longer have babies, I mean, you literally are kind of condemning your country to a much more diminished future.
We've got 3 of the best porphyry copper targets that I've seen in the past 25 years of exploring for porphyries. Vizsla Copper, we're the team that brought you successes including ISO Energy and Vizsla Silver. We've put our foot on 2 outstanding projects in central British Columbia with copper and gold and some molybdenum in there. Our Poplar South project, we're drilling there at the moment, and I think we're on the verge of a major discovery. If you want to learn more, you can find us at vizslacopper.com.
So there was a post you had posted on your X account. You all encourage you to go follow Adam there. And it was the Wall Street Journal. They said 4.8% of workers took hardship distributions from their 401k plans. Mm-hmm. So it sounds like people are scrambling to try to find whatever they can to survive or to make ends meet and such. And so what's your perspective there? Like what kind of problems is that a symptom of? I mean, I think we discussed a lot of that, but what problems does this create in the future as well? Because I do think that we have a retirement crisis. We're in a retirement crisis, but I think a bigger one is coming later on down the line.
Yeah. So I agree. And I think we're in a bigger retirement crisis than most people are aware of. And part of that is due to the fact that a lot of people don't pay attention to the difference between averages and medians. So I think everybody knows what an average is, right? But the median is the person at the 50th percentile in any given distribution. And averages can get really skewed to the high end around wealth because the people who have a lot of wealth pull up the average, right? Mm-hmm. And I don't have the numbers in front of me, the latest numbers in front of me. But if you look at the average amount of savings that somebody who is in the, 55 to 64 age cohort, the age cohort right before retirement, if you look at the average amount they have in retirement savings, it's not great. I mean, I want to say, depending upon whose data you look at, but it's somewhere probably in the low hundreds of thousands, right? It might be like 150,000 or something like that. And I apologize, I don't have the data here with me. That's not a lot for the next 30 years of your life, right? But that's the average. If you look at the median, it drops a lot lower. It's a lot more grim. I think it's something like, easily, I think something like a third of seniors have absolutely nothing saved for retirement. In fact, it's probably even bigger than that, bigger percentage than that. So yes, we have a lot of people who are just unprepared for retirement. I think it's going to be a tremendous issue, especially as the boomers really start getting to the point in life where they really need help. Right. There's still a lot of independently living boomers, but every year, the bolus of that cohort is getting to a point where they cannot live independently anymore. And an increasing number of them just don't have the means to be able to afford to do that. But to your specific question there about the spike that we're seeing right now in people that are taking hardship distributions from their retirement accounts, I think it's a sign of two things, one in the short term, one in the longer term. In the short term, it's just showing that people are really beginning to struggle. We're seeing an increasing amount of data that on average, the consumer is really starting to weaken here. During COVID, there was, an awful lot that was pushed into the system to try to help out people, right? We all got checks in the mail, or a lot of people got checks in the mail. There were moratoria on having to pay, a lot of your debts. So now all that's through the system. Right, the checks have been long spent. The savings that was built up has long been exhausted in people's savings accounts. the housing moratoria are over, and then relatively recently, the last one, student loans, went back into repayment. And I think that's actually a really big development because, for one, there are a lot of borrowers out there. I want to say there's something like 60 to 70 million borrowers of student loans. And a lot of them had kind of been sold by the previous administration that they weren't going to have to pay them back, that those loans were going to get forgiven. And because the moratoria was extended for so long, and because they were reading headlines that they might not have to pay the loans back, people shifted their behavior, and they started whatever they were going to have to spend on those student loans. They were just expanding, their own cost of living to fill that need, right? So they were spending on other stuff. So all of a sudden now they're being told, nope, actually you got to pay that stuff back, and by the way, you've got to pay it back. Unlike other forms of debt where you could maybe say, well, you know what, maybe I'm going to declare bankruptcy. Can't do that with student loans. And if you don't pay your student loans, not only can you not declare bankruptcy, but the government, who is the lender on most of these loans, can just garnish your wages. So, if they're like, you don't want to pay us back, too bad. We're just going to go to your employer and we're going to take it out of your check before you even get it, right? So, unsurprisingly, we're seeing a severe and immediate reaction to that. So we're seeing student loan debt delinquencies spike. I mean, just like a vertical line spiking. They were almost down near zero for the past couple of years because of the moratoria. Now, I think it's something like 31% of all lenders are delinquent on their student loans now. And this is only after like several months of these loans going back into repayment. And it's not just student loans, though. We're seeing this contagion creep over into other forms of consumer credit. So we're seeing delinquencies rise on auto loans. We're seeing delinquencies rise on credit card repayments. And we're now actually starting to see delinquencies even rise in mortgages, because people are saying, oh, God, I've got to pay the student loan payment. I don't have enough left over to cover my other debts. So where am I going to cheat this month? Right. So this could be, I'm not saying it's definitely going to be, but this could be sort of like the subprime of 2008, where, you've got trouble that starts in student loans, but it starts infecting other forms of debt classes. And then you get a debt crisis, a debt repayment crisis coming out of all this. So wrapping this all up in a bow, Daryl, I think despite the day you and I were talking, we had a pretty robust headline GDP print, right? Came out at 3.0% for Q2. It was above the 2.6% expected. So folks are kind of cheering, hey, the economy's actually doing pretty darn great, right? And I'm not saying the economy is going into the toilet right now, but I'm saying it's probably not as robust as it looks for a couple of reasons. One, if you scratch under the hood of this 3.0 number, it's actually a large part of that's driven by a decrease in inventories, which is positive for GDP. And it's the exact opposite what happened in Q1. So Q1, we had a negative GDP print, and that's because everybody built up their inventories because they were front running the tariffs. Well, now in Q2, they didn't make any new orders because they were selling down the inventories they had built up, right? So essentially Q1 really wasn't as bad as that number suggested. And Q2 similarly is probably not as good as this number suggests. But back to the data that I shared, we're just seeing a lot of this type of data, like the hardship folks taking hardship loans out of their retirement accounts, showing that the consumer is increasingly having a tougher time of making it through the week. And I think that's an important trend that's going on right now. And so I think there's reasons to be concerned the economy is going to continue slowing heading into the rest of this year. Let me just mention real quickly my longer concern here, which ties back to the wealth disparity that you and I were talking about, Daryl. I think, while I think most of what I just described are sort of short-term symptoms, and that I do see reasons to be more bullish on the economy a year or two out from now, I do worry, though, that the general trend of the assets and the advantages getting hoovered up by a smaller and smaller concentration of folks at the top of the top of society, leaving everybody else further and further behind. There's a concept I've been talking about that I'll just mention here briefly, where most of the people watching this video have probably heard of the term K-shaped economy. It was coined by behavioral economist Peter Atwater, largely coming out of COVID, basically saying, hey, look, it looks like these policy responses that reward asset holders and increased cost of living for everybody else, is creating this K-shaped economy where the top of the K are kind of your elite class that's going up and to the right. Their assets are going up, they're doing just fine. Everybody else is kind of falling off to the wayside. That's the lower half of the K. I think that is where we are right now. I'm concerned that over time, if these trends continue, we end up in what I call an I-shaped economy. So imagine a lowercase I, where there's a little dot separate and apart from everybody else who's doing fine. They're prospering, they're protected, but everybody else in that vertical line downwards is just falling further and further behind. I do worry that if we just keep playing this out, if we don't change our policies, if we don't change this momentum of wealth concentration, that in, we can argue the timing, but 10 plus years, it really feels kind of like an aristocracy, an I-shaped economy.
Yeah. And that could lead to, feudalism and some form of socialism or whatnot, where you have a few people that are at the top controlling, a lot of the narrative, a lot of what's happening, and a lot of people at the bottom struggling. So that's definitely something that I hope doesn't happen, but it's not looking too pretty.
Yeah, I think it's an America that nobody aspires to. Right. And I think America is a culture that won't stand for that forever. And you'll have some sort of, rebellion against it, some sort of revolution, hopefully not a French Revolution style version. And I guess the reason why I talk about it as overtly as I do is to say, hey, even if you're in the cohort that's doing well, right? Even if you're in the top half of the K, you've got to care about this bottom half of the K. We're all in this together in the end of the day. And you don't want to be in that society where the whole bottom half, whole bottom 99% or whatever they are, hits their boiling over point. It's not going to serve you well in that future either. So, what are the things that we can do policy wise to protect and preserve the ability of somebody to change their station, the ability of somebody to become really successful in this life, but not create this protected barrier that just isn't making it increasingly impossible for the rank and file, if they have the inspiration and enthusiasm and talent and intelligence to want to pierce that. If they can't, that's where I think we all get into a very concerning trajectory.
Yeah, agreed. I couldn't agree more. So just transitioning to kind of the heart of, our channels and what we do is to help people and figure this out, make moves to put themselves in a position to succeed or to benefit in some way, shape, or form. I want to do a thought experiment with you. So let's say, so right now we have 40% of Americans, they don't have $400 saved for an emergency. Many of them are living paycheck to paycheck, juggling debt, rising costs, things of that nature. And so if Adam Taggart was in that position today, what would be your step-by-step process of climbing out of that cycle, that trap?
Okay. So if I was one of those people.
Yeah.
Okay. All right. A good question. For a minute, I thought you were asking me to kind of come up with a whole policy solution to solve it, which I'd have some ideas on, but that would be a tall order. Hey, and while you asked that question, you made me think of something else that I should have mentioned when you asked, like, what kind of led to this big wealth concentration? A huge part of it, too, that I should have mentioned was globalization, was the fact that we basically outsourced a tremendous amount of our jobs to lower wage countries that underbid the American worker. It was great for those at the upper echelon of capitalism, of those who owned, the companies benefiting from that. But from a societal standpoint, it was a real step backwards. So, so if I'm I've only got, I can't even scrap together $400 right now. I'm living paycheck to paycheck. Okay. So first thing I would do is a total financial audit. What's my income? What are my expenses? Am I living within my means? Right. So is there excess spending that I really shouldn't be making? Right now, I think for a lot of the people who you described, Daryl, there's probably not a lot of fat to trim there, but there probably is some, and some probably are making unwise decisions. And, do you really need all that stuff, right? I'm going to assume for a moment that I'm single, because it's a harder problem when you've got mouths to feed, right? But once I've got my cost control down, that like, okay, I've got to make these expenditures, but I've whittled them down to the bare minimums, right? I would then say, okay, how do I want to start digging out of this? Right. I'm going to, if I can keep costs where they are, obviously it's going to be on the income side, on the earnings side. So how ambitious do I want to get out of here? Do I want to be in getting out of here and changing my station? And the reason why I say how ambitious is it depends how radical you want to be on your steps here, right? So like radical cost consciousness would be like, hey, I want to try to not even have rent, right? I'm going to just couch surf with friends and family for as long as I can, right? Live out of my car or whatever, right? I mean, just to be brutally frugal, right? And one of the reasons why I underscore this is if you read the book, The Millionaire Next Door, which is essentially 2 PhD summaries of studying self-made millionaires, the number one factor that self-made millionaires shared was frugality. So it starts all with cost containment, right? But then it's okay. So how do I boost my basically my earning muscle, right? I've started strengthening my saving, my cost control muscle. How do I start boosting my earnings muscle now, right? And obviously, if you've got a job, you can try to work more hours. You can apply for overtime. You can try to get promoted, stuff like that. But a good early question is okay, but where's that trajectory going to take me? Like, what's my maximum earning potential if I stick with the status quo? I might want to put myself on a different track that's going to give me a lot higher earning potential, right? So I think the first thing I would do is try to identify, is there a better, higher return track that I could be on that's still a good fit for my talents, my skill set, my desires, my how I tick, all that type of stuff. I think for most people, if they work hard enough, they'll find, hey, you know what, there's probably a better path I could put myself on. Once you identify that, then it's all about, okay, how do I break into that and how do I, make the most of it? From an individual standpoint, and I've actually written a very small book on kind of how to change your station like this. The book is called How to Find Your Way to Your Authentic Career. There's a lot of exercises in there, so I won't spend a lot of time talking about them. But there's a lot of things you can do to really try to both identify that track, but then, okay, how do I actually get on it and break into it? And for most people, your most valuable assets there are going to be email and the telephone. It's going to be talking to anybody and everybody who's in that space, learning from them so that as you start to apply for opportunities in that space, you're getting smarter and smarter about how it works. You can talk to it more intelligently. You can help people picture how you're going to plug into that world and the value that you can provide. And as you do that, you're also going to increase the odds for serendipity, where people say, hey, you know what? We're actually hiring for a guy. You sound like you might be perfect for it, Daryl. Or, you know what? Like, I'm not hiring, but my good buddy at our, one of our competitors said he's looking for somebody to mentor or whatever, right? So build your team of mentors, just work that flywheel of informational interviewing up until you get to the point where those doors are starting to open for you. Get in there, work like hell. To be honest, once you start earning above when there's at least a little bit left over after you've had to pay your essentials, then you want to be merciless about not just increasing your earnings muscle, but now working on your investing muscle. And so increasingly that surplus that you have between your paycheck and your expenses, you want to start putting that away. You want to save that like a crazy man. Borrow from Robert Kiyosaki. You want to pay yourself first. So the first check you write any given month is what you're putting away into your savings or your investing account. And in terms of paying your bills, you got to get creative how to make that happen after that if you're tight, right? But always make sure the first check, the first money that goes out of your wallet every month is going into that future account. And for the person who is following this process we're talking about, Daryl, honestly, I think until you hit about $100,000, you just want to be putting that money into a general S&P account. Just feed that, I'm assuming you're relatively young here too. You're not like 70 while you're doing this, but you're 20, 30, whatever, right? So just feed that S&P general market account until you get up to about $100,000. Once you're there at $100,000, then you can start talking about how to start diversifying, what to do with the surplus. You definitely should be putting some of that, just emergency-wise into things like your precious metal staff. I like your make gold, your precious metal stash. I like your make gold great again hat there. And honestly, when you're there, come to Thoughtful Money, actually talk to one of the financial advisors that we have at Thoughtful Money that will give you a free consultation to tell you what your options are from there. But once you're at that stage, Daryl, you're not that guy who can't make the $400 emergency payment every month. You're in a light years better station.
Mm-hmm. Yeah, agreed. And you mentioned a couple of points. So Jay asked me a similar question, pretty much the same question. And one of my answers was to pick up the book, The Millionaire Next Door, and Rich Dad Poor Dad. And so that was definitely helpful in my situation. So now just thinking about the macro environment, there's a lot of pressure on the Fed to cut rates. And so,
less so about today, but yes.
Yeah. And then thinking about the real interest rates. Okay. So, Fed cuts rates, people aren't really getting much yield on their savings and such. And you have to figure out where to park that capital so that you can beat inflation. We can argue about CPI inflation versus like shadow stats, but you have to beat inflation. So what are some ways that you're thinking about parking your capital in terms of beating inflation, especially if rates come back down significantly?
Okay. So if rates come back down significantly, you want to be in assets that obviously can either outgrow the rate of inflation. And so stocks can be a very fine asset class to beat inflation. In fact, historically, they actually have been a pretty good asset class to beat inflation. Obviously, at the end of the day, inflation is, as Milton Friedman said, anywhere and everywhere a monetary phenomenon, right? So obviously, I'm a huge fan of owning the precious metals. As an inflationary hedge, as a way to protect the purchasing power of my wealth. I actually think that they still offer, they've had a great run, but I think looking over the next couple of decades, I think they still offer potential, not just to shield you from purchasing power devaluation, but to actually increase your purchasing power as well. So I do think there's double reasons to own them. I think the commodity complex is going to do very well. And again, when you're trying to protect against inflation, you are trying to, you want to invest in things that have inherent value that can't be inflated away, right? So, no matter how many dollars the Fed prints, productive farmland has an intrinsic value, right? That's always going to, the market's always going to pay, close to fair value for. So, I think commodities in general, but I think looking forward to the future that we have lying ahead of us, there is a lot that says that commodities could actually have a really nice run from a relative appreciation standpoint. So I think not only will you get defense against inflation, but I think you could get a lot of potential real incremental gain. And that's for a couple of reasons. One, just reversion to the mean wise, the equity markets, their relative valuation to commodities is, or put it this way, commodities relative valuation to the S&P 500 is at like decadal lows, still near decadal lows right now. And just reversion to the mean suggests that there could be a really pretty strong pickup in commodity prices, or the price of the overall commodity complex. But then if you look at, and if you listen to guys like Rick Rule, very famous natural resources investor, I know your viewers know him really well. Rick has said for decades now, we have underinvested in the capex of a lot of critical natural resource sectors. And so even if demand just stays flat going forward, which it won't, it'll grow, but let's just assume it stays flat, we're going to run into pretty severe supply constraints or full-blown supply shocks with a lot of really key commodities. That's going to drive the prices of those a lot higher. And then if you look at the policies that the new administration is aggressively pursuing, the drill baby drill, the mine baby mine, they're really getting rid of a lot of red tape that has prevented a lot of natural resource investing inside this country. When you look at the amount of electricity production that we need to add, we need to we need to multiply by multiples, increase our electricity production over the next just couple of years to be able to compete more squarely with China. The amount of build out that is going to take, data centers, pipelines, new natural gas wells, it's going to be just epic. New nuclear plants, new forms of nuclear technology. It's hard not to see that unleashing a real bonanza for commodity demand. And again, that's not US only. I think the world is kind of waking up that, through globalization, we became way too dependent on a very small number of highly efficient supply chains. That's not what the future is. The future is having a lot more resiliency as a sovereign nation. And that means that we're going to have to make a lot more infrastructure investment in a lot of these different nations. So I think commodities have a really good future ahead of them. And I think that will also be a good way to protect against inflation.
Yeah, that's really good. Thank you for sharing that. Yeah, and it's interesting. You mentioned the like the competition with China and that driving a lot of some of these initiatives or whatnot, which there are critical elements of it, especially if they control a lot of the supply of rare earths and things of that nature, which can be lead to like national security issues. But I tend to look at life differently. Like the person I'm competing with is the man in the mirror, and and trying to get better. So I do think that an honest look at ourselves is important, as a nation, and seeing like, hey, we screwed some things up and we need to do better. I think that's important.
Well, I mean, I think that can be one of the real silver linings that we're taking from the, great amount of disruption that we've gone through with the past election. And then with, a lot of the initial policies of this administration that caught a lot of the world by surprise and whatnot, is whether you agree or disagree, it is a way to look back at the ways we've been doing things and say, look, is there a better way to do it? And I think it has opened the Overton window. It's opened the amount of options on the table we're willing to consider. And I think that's a really good thing. And hopefully, smarter minds will prevail. And I think that there's a lot of really, there's a lot of exciting interest. I mean, one of the things I'll really applaud this administration for is bringing in a lot of leaders from corporate America who honestly don't need these jobs. I mean, these guys in cases are not just millionaires, but billionaires. Who really don't need to be doing it, but they're stepping in because they have worked in the private sector and they have seen the opportunity and the impediments that we've been putting in front of it. And they're saying, okay, look, how can I help America really make the best use of the advantages that it has here? So I am guardedly really optimistic about what could come out of that.
Yes, agreed. Well, thank you, Adam, for coming on the show and everything. Appreciate you leaving us with a lot of things to consider, a lot of things to think about, and engaging with the questions today. So where can people find more of your work and connect with you?
Thank you, Daryl, and it's been a pleasure. Easiest way to find me, folks, is just go to thoughtfulmoney.com. And there you can watch. I do a lot of interviews like Daryl is doing here with me. So if you want to, do deep dives on a lot of key topics about the economy with some of the best minds and money in the markets, you can watch those videos or listen to the podcasts. But if you are looking for, so there's a lot of DIY investors, and I imagine there's a lot of people who watch your channel, Daryl, who are DIY investors. And hopefully my information can help you make more informed decisions. But, there's a lot of people out there who are kind of reluctant DIY investors where they've been burned by, a past stockbroker or financial advisor, or they go to their financial advisor with concerns like, I really think we should have some gold in the portfolio to protect against purchasing power devaluation. And the advisor will say, gold, are you crazy? Only crazy people, invest in gold. And so there's a lot of people that are shouldering the burden of managing their financial portfolios, but they don't feel like they're the best people who should be doing it. It's a different topic for a different day, but our education system does a terrible job of teaching financial literacy. So there's a lot of people who find themselves becoming good earners, but they just don't know enough about the fundamentals of investing, or they honestly just don't have the time and bandwidth. Like their talents are much better focused on what they do best. Succeeding in their jobs and earning a lot of money, or, managing their families or whatever. And so for those people, finding a good financial advisor who looks at the world with a similar lens like you and I and Jay do, Daryl, and can put together a financial plan and a portfolio strategy to plate all these trends that we're talking about for them and then execute it for them. If you fall into that category, if you go to thoughtfulmoney.com, there's a very short form you can fill out there and have a free consultation with one of the financial advisors that we endorse. And these firms are on my channel a lot. You can, watch the videos, see these guys kick the tires, but you can simply just have a free consultation with them where you'll sit down with them. They'll learn about your personal situation. They'll tell you what they think you should do. There's no cost. There's no expectation to work with them. It's just a free public service they offer. I don't know why anybody wouldn't do this. And then you can take that information and do whatever you want with it. You can use it in your own DIY efforts. You can take it to your existing financial advisor if you have one and say, I like these guys' ideas and do this. Or you might decide you might want to work with them. It's totally up to you. So anyways, that's kind of a very key function that I make available to people at Thoughtful Money, because at the end of the day, Daryl, I think Jay, you and I all share the same mission where we want people to be more financially prosperous, more financially resilient out there in the world. And if for a lot of people, finding these resources that can be helpful in being catalysts to get there can save them a lot of time and a lot of hardship.
Yeah, agreed. So you all heard it. Be sure to go over to thoughtfulmoney.com to connect with Adam and view some of his content, as well as connect with some of the services that are offered there. And you all, please be sure to subscribe to the channel, as we're going to be putting out more content and everything. So we'd love to have your support there. Thank you again, Adam, for coming on the show, and looking forward to having you back sometime.
Hey, my pleasure, Daryl. And if I can make one last plug, go to VRIC's conference in Vancouver in January, where
Yes.
Jay will be there, obviously running the whole show. Daryl will be there. I'll be there. You can rub shoulders with us, and it'd be wonderful to meet you in person. And I always find those in-person events great to be able to catch up with guys like you, Daryl, but it's really valuable for me to get like firsthand boots on the ground feedback from what folks value in terms of the content we're creating, what they'd like to see more of, what additional solutions they'd like to see more of. So anyways, folks, I hope to see you at VRIC in January.